This is FinTech Insider News. This week, Robinhood is getting into wealth. Sustainability fintech WeeFin are here to tell us about their Series B. And Monzo has launched a bunch of cool new stuff. And their new CPO is on the pod today to tell us about it. We'll be discussing all of this and more on today's show, so don't go anywhere.
I was never really a runner. The way I see running is a gift, especially when you have stage 4 cancer. I'm Anne. I'm running the Boston Marathon, presented by Bank of America. I run for Dana-Farber Cancer Institute to give people like me a chance to thrive in life, even with cancer.
Join Bank of America in helping Anne's cause. Give if you can at BofA.com/supportAnne. What would you like the power to do? References to charitable organizations is not an endorsement by Bank of America Corporation. Copyright 2025.
Hello and welcome to episode 951 of FinTech Insider. We're recording this in the same week as April Fool's Day, and fintechs have been getting in on the action, including our friends at Wise, who announced they were launching the Mega Wise card, larger than a car door. Yep, that's right. And Monzo, who decided to terrify their social followers by announcing that their annual Year in Monzo campaign, where they gently mock users' spending habits, would now arrive monthly. Fortunately, on this week's show, I'm not being pranked, or not that I am aware of anyway. Instead, I'm being joined by a great panel of experts to break down the week's biggest news stories. And don't worry, listeners, we've fact-checked them all. None of these are April Fool's pranks. So, first up on this week's pod, we have a FinTech Insider debut for Andy Smart, CPO of Monzo. Andy, it's great to have you on the show. And you've got a new role at Monzo. So first off, congratulations. You must be thrilled.
Thank you. Yeah, I was going to say, it feels like a new job for me. It's week 2, but I've been there for 9 years. So it's, it's familiar ground at least.
Yeah, amazing. Wow, 9 years. That's such a long time. That's incredible. Well, congratulations again. And next up, we have a FinTech Insider debut for Gregoire Hug, CEO and co-founder of WeeFin. Thanks for joining us, Gregoire. You have some exciting news, which we'll be getting to shortly. But in the meantime, please tell us a little bit about yourself and WeeFin.
Yeah, hello, David. Super happy to be here. And thank you for inviting me at the podcast. Definitely will be super happy to talk about the fundraising. Like you said, I'm WeeFin CEO and co-founder, and WeeFin is a fintech dedicated to sustainable finance. Our mission is to put sustainability at the heart of finance, and we do that by helping traditional financial institutions with a platform that allows them to better use ESG data when they invest or finance something. And I'm super happy in particular to be at the podcast because 11FS was actually one of my strong inspiration and model when we launched WeeFin back in 2018. I remember Mario, my co-founder, digging into your website to find great inspirations about product and marketing and build something super agile. So the loop is closed today, and I'll be happy to explain what we did since 2018.
Oh, awesome. That's so great to hear, Gregoire. It's great to have you on today. And last but not least, it's a warm welcome back to the podcast for Hannah Duncan, award-winning freelance journalist. It's great to have you back on the show, Hannah. How have you been since you last joined us?
Hi. Well, I don't know. The world's been really scary, actually. So, to be honest, I have been nervous, David. But in terms of like fintech and professional life, still writing about fintech all the time, too much even. I just finished an article right now, and after this call, I have to write another one. So,
wow.
Still at it. But thank you for asking.
That's why you're award-winning, Hannah.
Oh, thank you, David. And how have you been?
I've been great. Also nervous, but weirdly not about fintech.
Yeah.
Just about all the other stuff. But that's
all the
okay.
Psychos. Mm-hmm.
Yeah, all the psychos. But today we get just to talk about fintech, which is like cool.
Refreshing.
So that's our panel. And now on to the news. Our top story this week, and this one is from Finextra. Robinhood moves into wealth management and private banking. This story broke as we recorded last week's news show, so we wanted to give it a little bit more attention this week. Robinhood is expanding beyond stock trading, introducing wealth management, private banking, and an AI investment tool. Robinhood Strategies, as it's called, offers managed ETF portfolios for a 0.25% annual fee, capped at $250, giving Gold members expert managed investments. Robinhood Banking provides Gold members with premium banking services, including estate planning, tax advice, high-yield savings, and luxury perks, so all that private banking stuff. The upcoming Robinhood Cortex AI tool will deliver real-time market insights, aiming to democratize high-quality investment analysis. This expansion comes amid regulatory developments. The SEC dropped its crypto probe, but Massachusetts regulators are investigating Robinhood's new predictions hub. So, I mean, this feels pretty exciting, right? I'm pretty excited about it. Or are we? Hannah, are you excited?
Well, I think it's interesting because we've seen big banks do this the other way around, right? Like all the big wealth managers with all their like multimillionaires, they're like, oh, how can we get like the little guys? And now we're seeing it the other way around, that Robinhood is trying to like grow with their audience and make them millionaires and then serve them, I suppose. So that's kind of refreshing to see it that way around. I don't know. There's a lot of features all coming at once. Like, have you seen their feature that they're going to deliver cash to your door?
Yeah, I did see that. I was a bit like, huh? Why would I?
Yeah, I was like, is this clickbait? Is this nuts? Is this genius? Is it that weird line between nuts and genius? So, like, I think they're hitting us with loads of different things at the same time. But ultimately, it's a wealth management service for $250, right? And I don't know. Myself, I don't think it's going to take off. I heard someone describe it as like buying sushi at a gas station. Like it's the thing, but is it the real thing? I don't know. I'm kind of skeptical, so I think it could be good, but I don't know. I think it's a bit of a gimmick. What do you guys think?
What do you think, Andy? It's interesting to get your perspective, right?
I like it. I agree. There's maybe not the definitive way to do private banking, but I think anyone that's breaking down barriers to get folks into investing or to get new investors into new platforms and to reduce some of the friction that's been part of any form of investing, I think is got to be a good thing for the industry, whether this is the definitive solution or not. I really like that it's ETF based. I think we've seen a ton of innovation based around this new type of instrument over the last 5-10 years, and I think, if ETFs are the way to get everyone access to diversified portfolios, why shouldn't that apply for private banking as well? That seems reasonable. The bigger problem for me, and one we're more focused on, is that if you look across UK and Europe, it's 40% of investable assets are still in cash. You compare that to the US, 13% of investable assets are in cash. So across this landscape, how do we get more people actually trusting investments as a long-term way to grow their money? I think that's education. I don't think that's private banking. I think the focus then needs to be on actually getting people to understand the instruments they're investing in and the products that they're using.
What do you think, Gregoire?
Yeah, I think it's a smart move, not necessarily for Robinhood, but for the wealth management and the ETF industry, I would say. These guys are desperate to find new way to distribute their products. And in particular, for this kind of people, it's super hard to do something at scale for people that will invest only $200 or numbers like that. So I think it makes sense from the ETF industry. Then pretty agree with Anna. Sometimes you don't want to mix things, and you will definitely not use your small private bank to invest a lot. And 250 seems pretty low as a limit as well. So I don't know where they are getting with that.
It's also a kind of a different customer profile, or at least maybe a different behavioral profile, let's say. I mean, I don't know too much about the ins and outs of Robinhood's customer base, but, I imagine you have more active investors trading in stocks or making punts, shall we say, or plays, whereas private banking and ETFs and estate planning and all of this kind of stuff is very sort of, it's more of a formal long-term investment strategy. So it's kind of interesting, I guess, they're saying that, well, actually, we can just cover off both behaviors in the same platform. If you want to be risky, well, you can do all of that stuff. If you want to plan for your future, we've kind of got that too, including cash and Met Gala tickets apparently as well.
And the
So
markets got quite excited about it. They had a little ripple. So, but then I suppose the markets could be made up of a lot of the kind of people who would value that kind of proposition, right? So I think that it was like a good move for them. And Andy, like when you said the thing about breaking down barriers, I thought like, actually, I agree with that. Like that's exactly what I stand for as well. So I'm changing my perspective of it. I think it is a good idea, but I also think, I don't know if it's going to be a massive success. And unless they become a bank one day, which they said they're not planning to, I don't know, on the fence. But
yeah.
leaning towards yes.
I wonder if they're poisoning themselves towards this generational wealth transfer where, we've been talking about a lot around how the past generations manage their money in all forms of income and wealth, manage their money very differently to how the current generations and future generations will manage their money. And we don't really know what private banking will look like 20, 30 years from now, but it's a good bet that you'll do more of it on your phone, I bet.
Is Monzo going to do that? Is Monzo going to start going like wealth management and trying to capture these like rich young things?
Not necessarily. I mean, we're right now we're focused on new investors, but I think some of the principles behind this are very similar to how we think about the offering. The funds we use right now they're active portfolios, but they're made up of passive ETFs. And so the ETF as an instrument is incredibly powerful. It lets people get super cheap, easily diversified funds without having to think too much about it, and that's huge for getting new investors into the market. And we're currently focused on new and passive investors. We're not focused on private wealth or private banking, but who knows in the long time.
And also, Hannah, as you said, these things are all kind of very different, right? Like investing in an ETF is not the same as a private bank, really, is not necessarily the same as having cash delivered to your door, and is not the same as a Cortex AI investing co-pilot thing. It's like a whole bundle of stuff all put together. And, we've done research into private banking over the years, and on the private banking piece specifically, when you speak to private bankers, they will always tell you that when it comes to these things like estate planning, tax advice, yes, there are absolutely automations. For sure, there are automations that you can do, and there's some wonderful stuff. But being a private banker comes down to a human being able to speak to and understand another human. And that is expensive. There is a person that has to be there to manage that. And so if you were a tech business trying to automate all of that, how do you fit all of that together? It just doesn't feel like
yeah, they surely can't. Maybe they're just putting their fingers in all of the pies.
Yeah.
And they're seeing like, actually, this analogy doesn't work. Maybe they're throwing everything at the wall just to see what sticks.
Yeah.
Maybe that could be part of their strategy.
They're going wide. Has anyone seen the I think it was from the keynote or something like that, the run through of the Cortex AI tool? I thought that was very interesting. It's interesting to see an actual investing co-pilot kind of there, because we hear so much about these things under development. But yeah, it's not fully. It's not fully launched yet. I think it's only going to launch towards the end of this year, I believe. Something like that.
No, but I think it's key, because if you want to offer ETF to this kind of public, you'll need to customize a lot, because people will have very different ideas, will be willing to buy climate ETF, non-climate ETF, with specific thematics or others. So then definitely it makes sense to join AI and to have this capacity to automate a lot. And the thing that a private banker is doing, like the human person behind the private bank, will be actually to customize a lot the advice that he will give to people. He will give the same advice, but given the preferences and exclusion and and things that people want and don't want to do. So yeah, I think it makes sense. Maybe it's just the first move for actually Robinhood. They are testing the market here, and like Hannah said, it's not going to be massive, but maybe it's just the first step.
Yeah, we have to see how things play out.
I'm always skeptical of, particularly around investing, AI as the co-pilot or the decision maker for your portfolio. And I think we've seen a lot of companies that are focusing on how does AI make my business better, as in more investable, more marketable, and more of an edge. And I would love to see businesses focus more on how does AI help my customers, maybe in a less dramatic way. And talking back to this sort of human versus computer, still think there is a human need for reassurance and confidence that it's hard to get without speaking face to face with a person who looks like you, who sounds like you. And I think there's huge opportunity in this space for recent developments in LLM and AI to superpower the support those humans have in delivering that system. And I'd love to see more business focus on that. Of how do I, back to your point, humans are expensive, they're challenging to manage, all that kind of thing. How do we reduce those barriers down and make humans way more efficient, so that in the future I can talk to that financial coach on my phone and they're already armed with all the information to help me, but I'm still getting that reassurance from a human being.
Yeah, it's a fascinating time right now, isn't it? To see these business models launch over the next few years. All right, thanks everyone. Now we're on to our next story, and this one is from FinTech Finance. Monzo reveals that half of renters are unprotected as it launches contents insurance. UK challenger bank Monzo has launched contents insurance, making it easier and more flexible for renters and homeowners to protect their belongings. Research shows that 50% of UK renters lack contents insurance or don't know what it is, leaving millions potentially unprotected. The policy covers theft and damage inside and outside the home, with optional add-ons for high-value items and no cancellation fees. Customers can get covered in minutes, personalize their policy, and file claims in-app or over the phone. Monzo has been on a product launch roll recently, and this launch quickly follows their much-talked-about new split payments feature to help customers track, pay, and chase shared expenses hassle-free. So here we go. We've got Andy on the pod today, and Andy, congrats on the launch of this latest product. It sounds awesome. What can you tell our listeners about it?
It's very exciting. So we launched on, I think, Monday earlier this week. And this is the first launch for the new insurance squad at Monzo. So super proud of all the work they've done. And it's a new product category for us. Insurance, like lots of the other products we've worked on, is, I think, an industry that's ripe for simplification, education, and guidance. And when we speak to customers about their needs in the space, the thing we hear is that I don't really know what I'm doing. I'm asked loads of questions. I have to choose all these different checkboxes on and off. And then people aren't always sure if they're actually covered or not, or if when a loss event happens, whether they're going to get the support they need from their insurer. And so when we dug into that, we found like this is too good of an opportunity here for us to take some of the Monzo DNA and really apply that to this industry, and hopefully link it in with the rest of your finances so that it feels like insurance isn't this random thing you think about once a year when you get the letter through the post, but it's something that you trust is there for you and you can adapt as your life grows. My favorite little detail for those of you who haven't been through it is, as you go through the journey, we ask you how many people live in your house, and as you sort of tap the little plus button for however many people it is, there's a little shoe rack, and the shoe rack fills up with shoes. And if you put 8 people, the shoes are just thrown on the floor because clearly your house is in chaos if you've got 8 people living in your house. And so little details like this, I think, encourage people to take a step on that journey.
It's amazing. I mean, by launching insurance, I mean, I have to raise the prospect of an all-in-one super app. I mean, is this your kind of next vertical, and is there going to be another and another and another? I mean, how do you think about this sort of school of fish, as it were, sat inside an app container? How does it scale?
It's challenging. So we don't want to be all things to all people. We're very clear that our mission is to make money work for everyone, and so that's our focus. And so it's unlikely we're going to be offering book recommendations or taxi cab bookings at any time in the future. They don't really fit into that mission. I think insurance is very well within our scope though here, and we became a bank because that was important for us to solve that mission. But over time, we want to think outside of the constraints of what people traditionally use their core banking for. I think the hardest part of that is making it feel not like a supermarket where there's just everything on the shelves all the time, and you have to then go and like find the right thing you need, and to make it feel customizable and personalized for you, and without overstepping, actually highlighting these products at the right point in your life, so that you will need contents insurance at a specific point in your life. And you heard the stats. There's a ton of people who are just not protected. They're renting and they have either no idea that they need this insurance, or they feel like it's not something that's for them. That's a super important part of our mission. So that's why we stepped into this world.
It's fascinating. Hannah, what do you think about the super app term, and what's happening here in the UK with that?
Well, congrats, Andy and Team Monzo. I bet you've had some champagne this week. I love the super app idea. And I think insurance is actually a really good add-on as well. So I got insurance recently through my accounting platform. I go with Free Agent, and it was like, do you want insurance just for your freelancing business? And it's like £27 a month. And I was like, Actually, yes. Because if someone sued me, I'd be bankrupt and they could sue me. And I was like, this is genius. And since then, I've got so many add-ons, like I can pay by card and there's so many integrations now. And I just think a super app is obviously the way to go. I started writing articles about the super app in like 2019, something like that. And it seemed to be like a little bit slow, and I've kind of stopped writing about them now because it feels like, that was so 2019. But actually, like, they're really coming alive. Like, you could even say Robinhood, we discussed before, is now also becoming a super app, right? So I guess it's the race of the super apps. And like, if we're going to have a super app, how far do you think Monzo is going to go? Like you said, you won't be booking taxi rides, but like, where's the line for you?
I think the line's our mission. Thinking globally, like money is such an important problem for everyone on the planet. There are obvious boundaries and non-obvious boundaries to that, and so I think we've got tons of road left to run before we start running out of ideas of where we could expand next. I think also the trick is to make it not feel like a super app, because the notion of a super app almost implies this, overwhelming choice of, and there are some super apps that operate very successfully like that, but we think very differently there. We think ultimately our job is to make it feel like naturally your finances are there, and when you're opening the app, you're seeing the right things that are relevant to you. That's a really hard
and
bit
not
to
evil,
solve.
because sometimes they can feel a bit evil, like, oh God, this thing has all the control over me and like the people I have joint accounts with, and kind of scary. I really like Monzo because it's like, I have Monzo because it's like, it's just quite easy and good savings rates. So yeah, thumbs up. If I lived in the UK still, then I would probably have that insurance.
Yes.
I guess another way of looking at super apps really is building up a increasingly deeper picture of the customer, and anything associated with the home is going to give you a lot of information that you can then use in a non-evil way, in a positive way, to suggest things that can help improve a customer's life. And so that's a very powerful way of doing it. Greg, I want to bring you in on this from your perspective as a CEO of a fintech. How you think about horizontalization. I know this is probably a terrible word. Like, ignore I even said that. Moving left and right instead of up and down in terms of your feature set to broaden the reach that you have. How do you think about that?
Yeah, I think as a CEO, you always want to extend the range of your product, and because of course it's gonna help you to make more money about each customer, and it makes sense because then you're extending your market. So we are focused on sustainability, but even in sustainability, you've got data, calculation, reports, and we always are trying to, I don't want to say the word myself, but to be more horizontal, if you want.
To be more of a what?
To be more horizontal and not a pure vertical. But I think it's a nightmare for CTOs, I would say.
Yes.
Then the limit is not only the culture, but is as well, are you bringing any added value with your technology, and can you do the things better than your competitors?
Yeah.
And I think, like for Monzo, for example, having bank and insurance at the same time makes a lot of sense, and that's a place that we can understand here.
Yeah. Well, you raised the CTO, and actually let's talk about releases here. Talking about a CTO's headache, and the pace is just incredible for what you guys are doing. So app updates in 2025, banks in the UK, NatWest have done 4. Nationwide have done 6. Monzo have done 18. I mean, the pace is just incredible. How? I mean, there's probably an entire podcast about this, really. But like, how do you do that?
I think that the more impressive stat is, I think we deliver updates to our product hundreds of times a day.
Yeah.
So I think the key is we think very much like a technology company. We are a bank. We take that responsibility very seriously. We are a financial institution, but at its heart, we're a product company, and therefore we have to operate and think like any leading product or technology company. And that means structuring our teams so they can talk to the customer directly and learn from that interaction, and then actually deliver value super quickly. And I think about these as like mission-driven teams. So rather than saying you've got your engineering team over here and they do all the engineering work, and then the product team tells the engineering team what to do, and the CEO tells the product team what to do, and then it's like a factory line, and that can be quite slow and slow down very quickly when you become a big company. We think of each of our teams as little companies inside a broader company. And so the savings team have research embedded in them. They talk directly to our customers to understand what's working and what's not. They've got design in there, they've got engineering in there, they've got product in there. And so they think about their roadmap themselves, and they work as part of a broader organization that's got a strategy. And that then empowers people to make decisions based on what the customer wants, rather than decisions based on what the hierarchy of the organization wants. And that means we can make decisions very quickly, and that means we can then get things into customers' hands very quickly. That structure has scaled pretty well for us over the last few years. We've taken that from right back when we founded. That was one of our principles. We wanted to be mission-driven. We wanted to be transparent. We wanted to work directly with customers. And we've been able to retain that for the 9 years I've been here, at least, and been able to scale that as well.
Andy, since you say mission-driven and transparent, are you going to start doing any like sustainable finance then? Like, where you reward people for, say, lower carbon purchases, or where you somehow incentivize sustainability?
We think very carefully about it. I think ultimately it's then the customer's choice. We think about this in terms of investments as well. For example, all the funds that we started our investment proposition with, we chose ESG funds specifically because we didn't want customers to have to face the choice of ESG versus non-ESG for lots of people who didn't understand that. And that was a step there. But equally, we don't want to take force specific opinions of our own onto our customers either. We want to make sure they're presented with the right facts and information so that they can then take choices that reflects their priorities in life. So absolutely, it's important consideration for all of us. And we think about it across lots of different product vectors, but I think we stop short of forcing our customers to take a specific choice.
I'm going to keep an eye on this going forward now. I've lodged it in my brain.
Well, Hannah, we've got a slightly more extensive conversation coming up on ESG, so we're going to get to talk more about it. It's a good cue into it, actually. But before we move on to the second half of the pod, Andy, I just want to say congrats again on the launch of all these features. So without giving up any secrets, can you give our listeners a little hint about what's coming up next?
Well, I mean, I've talked about our mission, I've talked about the boundaries of it, and I don't think we've reached those boundaries yet. I'm going to keep my lips sealed on any big, exciting, major new product launches. But you look back over the last, let's say, 12 to 18 months, we've launched under 16s, pensions, investments, now insurance split. We don't think any of those are in their like terminal state. There's loads of work to do in each of those. And so we've got teams working across that whole spectrum to build those out and think about what comes next in each of those. And you'll start to see those come through as we go through the year. But also blurring the lines of those and making them work more harmoniously together. We don't want to become an app that's just a set of boxes and you jump from one box to the next. We're really thinking about how can your saving and your investing come together in simple ways. How can your insurance link into your considerations like your mortgage and others. And so you'll see a ton in that space as we go through the next year.
Awesome. And on that note, we're just going to take a quick pause here. Back shortly.
Cybersecurity is the top concern for UK businesses, according to Vanta's recent State of Trust report. But whether you're a startup founder or an experienced security professional, Vanta is here to help. Businesses use Vanta to establish trust by automating compliance needs across over 35 frameworks like ISO 27001 and SOC 2, centralized security workflows, complete security questionnaires up to 5 times faster, and proactively manage vendor risk. Join over 9,000 global companies like Flow Health, Synthesia, and Alica Bank who use Vanta to manage risk and prove security in real time. For a limited time, get $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.
This episode is brought to you by Audi. The road is calling. Embrace the thrill of the drive with the all-new, fully electric Audi Q6 e-tron. Featuring effortless power, serious acceleration, and advanced Audi tech. It's not just a new EV, it's a new way to experience driving. The all-new, fully electric Audi Q6 e-tron is here. The next chapter of Audi starts now.
Welcome back. Before we get back into the news, I wanted to tell you about our latest Insight show. Is crypto still the rebellious outsider in finance, or has it finally earned its seat at the boardroom table? To find out, I'm joined by guests from Coinbase, Fiat Republic, and Zumo. The podcast is out now. Just head to the episode below this one to tune in. All right, back to the news. And our next story is sustainability fintech WeeFin raises 25 million euros. That one's from FinExtra. WeeFin, a fintech that helps financial institutions manage their sustainability strategies, has completed a 25 million euro financing round, Series B, led by Blackfin Capital Partners. WeeFin provides financial services companies with a SaaS platform that centralizes all the data needed to deploy and manage ESG, impact, and climate risk. The company currently has more than 40 customers across Europe and strong growth in recent years, with 30% of total revenue coming from international sales, up from 0% just 2 years ago. So we are obviously delighted to be joined by Grégoire Hug, CEO and co-founder of WeeFin, today to tell us more about this. So Greg, firstly, congratulations on the raise. And can you tell us a little bit more about the SaaS proposition and how WeeFin helps companies with their sustainability goals and ESG strategies?
Well, thanks a lot. Yeah, indeed, we are super excited about the fundraise and the future deployment and expanding in Europe. So to tell you more about WeeFin and the platform, we are a mission-driven company. And the mission of WeeFin is to put sustainability at the heart of investing and financing business. And to reach that goal, the idea we had is to build a B2B SaaS platform, if you want, that will target all the traditional financial institutions, guys that could be general investment managers, for example, in our client list, or could be Natixis, if you know them from French investment managers. And the clients will be investment managers, wealth managers, bank, pension funds, also traditional financing business. Our goal is to make these guys use ESG data when they are investing or financing. And the play is that actually, we know that ESG is no longer optional and that financial institutions are facing regulatory or client demands. Just one example that happened in the UK, for example, the People Pension Fund just changed a mandate of 28 billion pounds from State Street to two other investment managers because State Street stops to do ESG, thanks or not thanks to Trump. And by 2030, there will be more ESG investing. So the rise is supposed to be more than 200%. And so with that in mind, if you look at ESG analyst teams, so all the guys doing the job, day-to-day job, to integrate all these ESG criteria in traditional financial institutions, they are actually facing huge operational risk and high cost. They are managing thousands of ESG data points with no technology purely dedicated to them. And so we decided actually to develop that technology and to become the ESG operating system that they're going to use. To give you the idea of the scale of data that we are managing, on average, our customers are using more than 5 different ESG data sources to cover all their asset classes, to integrate that in all their businesses. But the highest number that we saw is 30. And actually, a folk like generally will have more than 10 different sources. It means that they'll have around 500 data points against each of their investee company or each of the projects that they will finance. That's a lot. That's a lot to cover. And WeeFin is here to help with the functional knowledge, with the technology to have everything automated so that they can focus on investing.
Hannah, what do you think? I mean, you raised ESG in the last segment. I mean, it's definitely it's been a complex area in the past, right? With, people and businesses really not knowing necessarily where to start. So something like this is very important to get quality data that investment houses can actually action on, being very important. And you also mentioned, Greg, a substantial increase in the uptake of ESG investing, which is great news.
Well, I just want to say massive congratulations to Greg and team.
Thanks.
How stressful was that to get the funding?
It was actually okay. Well,
Really?
it is always.
It's a lot of money, Greg. It's a big round, you know.
Wow, we should get you on board for our project.
No, but it is actually stressful, of course, to fundraise, but it happened pretty quickly, so no time to stress. We had actually 3 different term sheets in just a few days. So the fundraising was done before the roadshow even started. So we are really amazed to see investors following our play, seeing this as a huge opportunity as well, and seeing that we've got the team and the product to actually be the leading platform on that market. So it happened pretty quickly. Of course, it's a lot of money, and now I'm pretty stressed to better spend the money and to develop and to make sure that our launch in the UK here, we have an office and we have a few first customers, but we are trying to expand. So it's going to be one of the key things that we are trying to do in 2025.
Massive congratulations. I think WeeFin is a SaaS platform that the industry has been like begging for a lot of years now. Because on the one hand, there's like messy and confusing data. And then on the other hand, there's wealth managers who just don't have the time to sort through it. And then on top of that, like really ever more stringent regulations, especially in the EU. So I think that the SaaS product itself is, I mean, I'm not really surprised that you got funding because it's obviously needed. But I do think there's some serious question marks about the data itself, which is obviously not WeeFin's fault. And for example, when I had a quick look today, I saw that one of the kind of rating agencies used is MSCI. And I think MSCI is a very questionable rating agency because when I looked at their like top 10 holdings, they were things like Coca-Cola, which is obviously not good for anything. It's not good for people. It's not good for the environment. It's not good for society. It's not good for nothing, and except money. And they also have like Microsoft that uses technology to fund oil, and like Google that's now using AI to build weapons, and Tesla. So I think that a lot of the actual data itself is surely going to come under scrutiny, and I think there's a scandal waiting to happen there. But that's not your fault. And you're building a bridge that's very much needed between the two worlds. What do you think?
And you're totally agree that it's a key challenge of sustainability and in particular of sustainable finance. We see ourselves as a bridge in between the financing world and the sustainability world so that both worlds can better understand themselves. So we kind of translate the ESG data into an actionable investing data points. And you're right that sustainability data providers could be questionable. It's not that their data is not good, actually. It's that inside the methodology of each of their scoring, you've got a lot of choices, actually. And one of the way of seeing WeeFin is a way to open the black box for managers so that they better understand the data providers that they are using, MSCI, Sustainalytics, and others, and so that they can better use their data. And you would not be surprised, I believe, to hear this stat in particular. We have more than 80% of our customers, so big banks and investment managers, that are actually creating their own ESG scoring so that it fits exactly their needs. So they are using MSCI data and Sustain and other data providers, but then they build on top of that their own score so that it fits exactly to the belief they have and their investing side, actually.
That's lovely. So you can, I like that. So you can incorporate your own philosophy. Is that something that you build into your platform, or is it something that they do separately?
Yes, that's one of the key features that we've got, a capacity for them to actually create their own custom scores directly in the platform and to use that. And the next game is actually to push that ESG scoring into the wealth management and into the customer space so that actually, and to loop that, someone in a Robinhood or in Monzo could actually have their own sustainability view. And that's it's.
That was a plug to Andy.
Yeah.
That was definitely a plug.
Go on, Andy. You got to take it.
It's super cool. And maybe we should have. I don't think it'd be super close to WeeFin and Greg, but we should definitely have a look. I know, obviously, ultimately the goal here is to try and get this into customers' consciousness to help them understand what they're doing, what they're investing in. I do think as an industry, we talked about ETFs earlier, and as an instrument, that's super helpful for us to be more specific about what people are investing in. If we go back beyond that, funds were super opaque, super complex to understand, and now you can buy a clean energy ETF. So go beyond ESG, you can buy something that's specifically focused on only companies that are furthering clean energy. I think that's great.
But
for consumers.
it's still quite opaque. Like
Yeah.
for this call, just so I could have some examples of how bad MSCI is. I already know that's how I won the awards. I wrote about how bad they were, but just so I could have some up-to-date evidence, I had to go through so many loopholes, like just to try to find out what's in their fund list. It's still super opaque. And a lot of the like ETFs you look at for energy, they're not actually like renewable companies. A lot of them, they're like companies that promise to be renewable in the future, but not now. And like, there's a lot of like not really doing it going on. And there's a lot of greenwashing still. So I think that like anything like this is great, especially as like a regulation technology tool, anything that can further it along. But I think it's one step in a massive journey. And I kind of worry that it's going to take too long because we actually don't really have very long. We're already on track for a 3-degree world now. We don't really have time for this like step-by-step thing. But nevertheless, I think it's great that you've made a huge step.
Yeah, in some ways, it's kind of awful that, the transparency just hasn't been there, but at least the transparency will help with making behavior change. And there is another stat we have here, which I think really supports this case, which is a poll of over 2,000 HSBC and Barclays customers in the UK from researchers at ICM Unlimited, found that 80% were unaware that their banks invest in fossil fuel. I mean, that's just incredible. It's 2025.
But that's not surprising because those two banks are the two worst. Barclays is the seventh worst in the whole world, and HSBC is even worse, I think, right? So if you're still with them now, then you're obviously oblivious. I think if you were to ask somebody from like any other bank that's not in the top 10, if you were to ask like a Triodos customer, then they would know. I think that sample set must be biased towards like climate ignorance, right?
Well, I mean, and the second part of the stat is interesting in of itself. So it says that, however, when faced with the facts, 12.5% of respondents said that they would be very likely to consider switching banks. Now, you could argue that that is a high number. You could also argue that's a very low number, right?
That's a low number.
Yeah, I would have said it's actually quite a low number. I mean, it's equivalent to roughly 3 million customers, but there is still a passivity, I think, that comes there that startups like yours, Greg, are going to start interrogating to move forward. So, right. Thank you, everyone. This is super interesting. And there are several podcasts we could do just on this topic alone, I'm sure. And we're going to move on to the final one for today. And this one's from Finextra. So, Wearable UK tipping fintech launches. Right. And this is a business called thankyü. Hull-based thankyü claims the app is the first decentralized peer-to-peer tipping platform powered by payments tech firm Viva.com and MasterCard Move. thankyü was designed to help employees and employers following government legislation that came into force last October in the UK that requires employers to share all tips, gratuities and service charges fairly and transparency with their employees. Finally, it's been much needed. The government claims workers will see an extra £200 million from these changes. Before the Act, tips were often collated centrally when the bill arrived and then distributed up to 60 days later by the employer, or quite frankly, sometimes not at all, really. If you ask a waiter or waitress, they very rarely get it. Sometimes with very little transparency or fair representation of the service provided, says thankyü. The thankyü app allows tips to be collected by hospitality and service staff and keep them in their own personal wallet, and if they wish, share them with fellow employees, family or friends, or transfer them to their own bank account. So before we get into today's discussion, we asked our 11FS Pulse head of product, Joe Colchester, for his thoughts. As someone who spends his days analyzing fintech products and journeys, we wanted to get his take. Let's hear from him now.
Yeah, so I like this idea a lot. I like it because it means the tips actually go to the waiters. That hasn't always happened. So to be able to use technology to solve that problem is brilliant. And it's also great because it means that they don't get tax on them. So two huge wins there. And I think it's a really clever little initiative. I think there's a little bit of a concern about whether it will really be used because of the slight awkwardness around the payment. It's slightly strange to receive a payment on your wrist. A helpful thing about the payment terminal and adding a tip onto it is that it's very discretionary. You can do it in your own privacy. This adds a slightly strange dynamic where the waiter will ask them whether they want to add a tip, and then they'll hold out their hand for it to be tapped. This is a bit awkward and not very discreet. So we'll see if it takes off, and I really hope it does.
Oh, yeah, I agree, Joe. That is a bit weird. What does everyone think? I mean, great idea, by the way. I agree with him. The idea is fantastic. But the mode of delivery, I guess, that is awkward.
I mean, we Brits are an awkward culture to begin with.
We are.
So, and tipping is already an awkward part of that. I think it is a great idea, and I think the initiative and the backing of it is clearly like something we need to do. How can we make tips less awkward, I suppose?
It's a good mission.
I'll actually take my country angle. So probably notice with my accent that I'm coming from France, and actually the tipping culture is not very good in France. You are not giving tips at all, and we've seen a lot of technology happening in the past years in banking terminal and stuff, asking you for tips, and I don't think it's like working a lot here. And yeah, really think that this will be a bit awkward, actually, from our cultural point of view, to type directly the things and not putting the cash in the table and like being more discreet. So it's going to be hard, at least in France, to kick off this kind of business.
What do you think, Hannah?
I have been on a journey with this story, let me tell you. When I read it, because I used to waitress. I waitressed in 6 different places in Wales, where I'm from, England and Switzerland. So I have like a good mesh. And at first I thought, yeah, fabulous, because I would have had zero hesitation holding out my wrist. Not a problem at all for me. If it means I get money, probably some weird man would have tried to hold my hand, whatever. I would have dealt with it. But the thing that I find really strange about this is that it would have created a very bad dynamic with my team, because the rule is that we share all the tips. And like, it is a bit frustrating when you have to share tips with like the chef or the owner. That's not nice. But we share all the tips, and you never fully know how much you got, like how much you put into the jar. And you don't never fully know because you just grab it and throw it in. And you never really know how much the other person did. You just know that at the end of the week, you've got between like 17 to 40 pounds each, all of you, distributed equally. And if it was because I was quite like front of house, as you can probably imagine, I think I was quite a big earner when it came to tips, I reckon. So I would have been like going up there, getting my tips and not sharing them. And then nobody would have wanted to be my friend. And the customers who were like big tippers, we would have all run to them. And the customers who didn't tip anything, we would have ignored them. And I think that there would have been a lot of resentment to the people, for example, cleaning the tables. They don't get tips normally. Or the people like just washing the dishes, they don't get tips. Like if I was collecting all this cash for myself, I would have been so unpopular. The rule is you share it out. Even if once I got £40 and I put it in and I got nothing back at the end of the week, I got £3.50. It's the rule. It's the camaraderie. You share your tips. So I've come on a full-scale journey, and I think whoever invented this has never worked as a waiter. Good idea, but in practice, it would make a bad culture. What do you think, David?
So interesting what you're saying. I didn't think about that angle at all, but yes, it's
I'm
right.
poor.
Well, I mean, I've not been a waiter, but I have had loads of friends over the years who have been, and they actually have all said the same thing. It's pooled, and there is a real belief that that's the way it should be, and this could create some disincentives for that. On the other hand, the tax issue is significant. It's huge. And if it is pulled centrally, right, particularly if all of the payments are coming in by card, so it's all auditable, right? It's not cash. And that, you have to pay a percentage of that in tax, whatever that is, That is money. And then when you add in the national insurance contributions for the employers on top of that, increasing to 15%, that means that a cafe, say, earning something like £20,000 in tips every year, might have to pay £3,000, for example. So there is a clear financial incentive to do something like this.
But that can be solved in other ways, right?
It could be solved in other
wearable.
ways.
Like that's a completely different problem to what this solution is.
We're
right?
saying that the wearable is kind of the issue here in some ways. There might be another way to do it without creating those kind of weird competition dynamics.
It would be awful. It would be so toxic, honestly.
Yeah.
Everyone would hate me. And I would hate them back. It would be terrible.
Maybe we could use this technology differently. And for example, in different businesses, back to your point that in cafe and restaurants, you are sharing tips, but in theater, for example, I don't think people will share tips. So probably it's a technology that could be used to generate tipping culture in different businesses rather than...
Or taxis or hairdressers.
Yeah. Right. Yeah. Absolutely.
Children's entertainers.
Yeah.
Yeah.
Just saying things now. But yeah, like, I don't think restaurants is the thing because unless it could be programmed that the tips go into a pool and they're distributed equally. But even then, if you see exactly how much you made and exactly how much you're getting back, you're going to get really grumpy.
I am also very awkward with tips.
I can imagine that, David, actually.
Can you? I'm extremely awkward. I know I need to.
Voice.
I very often know I need to tip more or just tip in the first place and then don't and then feel very guilty when I leave the restaurant. I feel like this is a very English problem to be having.
I like that we're gradually converging as a society of tips being added to the bill, though. I think that's probably best for everyone.
By default.
Exactly.
I don't know, because then it's just there, like 12.95% or whatever, and it's like quite expensive. And you think, okay, I didn't really plan for this, and I don't get like the happy feeling of giving you a tip. So I don't know. I have a cousin, and he always like makes a big deal of like getting them to take it off, and it's very orcs. And then he goes and he gives it back to them in cash.
Yeah.
And I think he goes on a journey, every time.
It's funny you say that because my friend, I have one friend in particular who's worked in food and beverage for many, many years, and he makes a point of doing that. And he always keeps cash in his wallet to give to this. Like, no, I am giving you cash,
Yeah, I do that too because like you need the coins. Absolutely. Yeah. Although here in Spain where I live, there isn't really a tipping culture. So I don't know what I'm saying anymore. I'm just taking credit for something I don't do. But in the UK, I used to do that.
All right. Now for a quick look at one more newsworthy story this week that we don't have time to cover in full. This one is from The Guardian. OpenAI raises $40 billion in deal with SoftBank that values it at $300 billion. So OpenAI has raised $40 billion in funding, led by SoftBank, valuing the ChatGPT developer at $300 billion. The investment will help OpenAI push AI research forward and accelerate progress towards artificial general intelligence, or AGI for short. SoftBank is contributing $10 billion upfront, with an additional $30 billion by the end of 2025, alongside Microsoft and other tech investors. OpenAI is also shifting strategy by developing an open-weight AI model, allowing users to fine-tune its technology amid growing competition from Meta and DeepSeek. Recently, the company's new image generation tool in ChatGPT has driven a surge in user growth, with millions embracing its Studio Ghibli style art capabilities. Well, I mean, aside from some of the IP issues that comes with generating Studio Ghibli-style art capabilities, it is definitely an amazing thing. And look, OpenAI is an absolutely incredible company. However, there is a counterfactual to this. This fundraise brings OpenAI, I think from a source I'm looking at online, to being the second largest or second most valuable private company currently. Only ByteDance is ahead of it, and SpaceX is just behind it. And this is the single largest tech funding round on record. And A lot of this is due to the hype around AGI. Can they make it? There is a bit of an arms race towards it. But there is also a pretty healthy body of evidence and counterfactual online, which shows that AGI, certainly with the existing generation of AI and the sort of the underlying capabilities that underpin LLMs, is just not really being able to reach it. I would highly encourage listeners to check out the AI Supremacy Substack. They have a very good kind of counterfactual on this, and they talk about a recent survey from a whole bunch of AI researchers basically saying, look, I mean, it is just extremely unlikely or very, very unlikely that AGI is going to succeed in this particular model. So it's one to look at. It definitely feels a little bit like a Silicon Valley shill in some ways. Okay, and we're going to move on to our final segment for today, and this is the "and finally" segment. We have some good news. According to the BBC, there has been a big drop in child surgery for swallowed objects. So what has this got to do with fintech? You might be wondering. Well, let's find out. Stick with us on this one. A shift towards cashless payments has led to fewer children swallowing coins, reducing the need for surgery, according to UK surgeons. Hospital records show a 29% drop in foreign object removal procedures from 2012 to 2022, with nearly 700 fewer cases. Coins once made up 75% of swallowed objects in young children. But childproof packaging and safety campaigns have also contributed to the decline. Removing foreign objects from ears and noses costs the NHS around £3 million annually, with children responsible for the majority of the cases. Has anyone here swallowed a coin?
I put Play-Doh in my teeth because I was doing an impression of Freddie Mercury and it just didn't come out. And it was like I needed like a procedure. Yeah, it was like really salty. But I still remember it as a trauma. But no, I haven't. And it was blue as well. I haven't swallowed a coin now.
Oh my God, I've swallowed Lego. Definitely swallowed Lego. I mean, recently, like last week. No, a head. I swallowed like a Lego head.
Did it make you feel powerful?
7-year-old me was filled with power. I mean, did anyone feel like cashless, like this would be a benefit of a cashless society? This is not something I realized would happen, but it's a good thing.
It wasn't first on my list, to be honest. I still quite like cash. I would like to see cash come back a bit.
Did everyone have
to eat it
piggy
or
banks?
just to use it?
Depends on the day.
Okay. Depends on the flavor, the texture.
Yeah.
How
much as well. I wouldn't go for a 2p, but maybe a 50.
We have to build a Lego-less society now.
Virtual Lego.
A sadder society, I think.
That would definitely
I did some research as well. This was for Australia, for like the top 10 things swallowed by children. And number 1 is actually beads. So it's beads, coins, and then a really horrible one is button batteries. And that's really bad because they burn. Yeah. Button batteries, Lego, like you, David. Food, which I thought was weird to put on the list. Magnets, glass, other types of batteries, marbles, and medication. Those are the top digested things by children.
Oh, wow. Yeah,
beads, beads, like they look quite nice, to be honest. They're usually shiny, colourful. I get it.
Do we have Taylor Swift to blame for that?
Why?
Isn't that like a thing? Like beads?
Are you just blaming Taylor Swift for everything now, David?
Yes. Isn't that a thing? Lots of beads. I am not going anywhere with this at all. But yeah, I mean, there are some fond memories that I have as a kid of piggy banks. I had a bank kids piggy bank thing that was pretty cool. I mean, that's another thing that might disappear, I guess, as cash sort of goes away.
I hope not, though.
Oh, I know. I hope not as well. I mean, I remember working on a digital piggy bank thing for a bank that I won't name a few years ago. That was very, very interesting. So how can we replicate that sort of physical, digital piggy bank experience?
I feel like you didn't manage it. Did you manage it?
I don't think I managed it.
No, because it feels like a sort of sad replica of a lovely thing, doesn't it?
It's a great idea, though. I had a great name as well.
Go on. Who was it?
I don't think I can say. I don't think I can. Yeah, because it might be launched.
Hot goss.
Yeah, okay. Hot goss. You never know. Might be there in the market at some point, if not already. Does some quick Googling. All right. Thank you, everybody. That wraps up this week's FinTech Insider News. Thank you so much to today's guests. Please, all of you, tell us where people can find out a bit more about you and your companies. Andy.
Go to monzo.com or search Monzo on the App Store and you'll find us.
Awesome. Greg.
I'm not going to be really different there. Go to WeeFin.com or in LinkedIn. We are publishing a lot of stuff regarding the fundraising. So happy to see you there.
And Hannah.
Okay, my website has a really long name. I regret it, okay? It's hdinvestmentcontent.com. I know I need to get a shorter domain. It's just really expensive. But hdinvestmentcontent.com is my website. And then on LinkedIn, I'm Hannah Duncan. Connect with me, please. Would be nice.
Awesome. And as for me, you can find me on LinkedIn at David BG. Thank you so much for listening to today's FinTech Insider. If you like what you heard, please make sure to follow us on your favorite podcast platform of choice. And if you really like what you've heard, why not share the podcast with a colleague or friend? As always, if you want to join the conversation, find us on social media. Just search for 11FS or FinTech Insider or email podcasts at 11fs.com. Thanks again and goodbye.
Cybersecurity is the top concern for UK businesses, according to Vanta's recent State of Trust report. But whether you're a startup founder or an experienced security professional, Vanta is here to help. Businesses use Vanta to establish trust by automating compliance needs across over 35 frameworks like ISO 27001 and SOC 2, centralize security workflows, complete security questionnaires up to 5 times faster, and proactively manage vendor risk. Join over 9,000 global companies like Flow Health, Synthesia, and Alicabank who use Vanta to manage risk and prove security in real time. For a limited time, get $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.